Welcome back. Let's take a look at the markets. And as we just did, there they are, trading in positive territory. Our next guest is a longtime market professional. He says the S&P 500 should continue to see upside in months ahead. He's calling for a higher S&P 500 by the end of 2026. Joining us now is Scott Wren, Senior Global Market Strategist at Wells Fargo. Scott, thanks a lot for joining us. Let's first of all talk about the news from Washington, that large piece of legislation that includes tax cuts has now cleared the House of Representatives. It's on its way to the Senate. How material is this to investors' perceptions of the economy and the markets?
Well, I think that the market assumed that these 2017 tax cuts are going to be extended. We certainly did. So I think that part of the equation is going to happen. But, you know, the Senate is going to look at this. The Senate is not keen on really cutting spending. It doesn't appear like it. And so I think they're going to make a number of changes here. But Senate Leader John Thune, Majority Leader, he is very insistent that this is going to be on the president's desk for his signature by July the 4th. So I have some confidence there, but certainly, there's going to be some heavy duty negotiating in the Senate. I think the market, though, tax cuts, that's good, but the market, clearly with these bond yields going up is at least temporarily a little concerned about the deficits that we're still going to be seeing in the U.S.
Right. Lower taxes were part of the reason that the S&P 500 moved up immediately after the election of Donald Trump in November. This is the legislation that markets have been waiting for, correct?
Yes, it is. And like I said, I think the market for a long time has expected the 2017 tax cuts to be extended, if not made permanent. And certainly if it looked like that, if it looks like that is not going to happen, that is not going to be friendly for the stock market in any way.
Okay, you are calling for the S&P 500 to move higher. We are about halfway through 2025 right now. We've had an explosive rally over the past 5 or 6 weeks. You see the S&P 500 higher by the end of 2026. Give us your read on the U.S. stock market.
Yeah, I think that it's going to be our target 6,500 for the end of next year. But for right now, I think we're going to likely see a little downside here. I think there's going to be uncertainty over growth. There's going to be uncertainty over inflation. There's going to be uncertainty over what the Federal Reserve is going to do. And so I think this hard data that has been pretty good in the U.S. is going to start to deteriorate. And really what we're hoping for is that we see a little bit of downside here. The pullback that we had encouraged clients to step in and buy. We've liked technology, communication services, financials, in particular. So we think we're going to have another opportunity here. I wouldn't be buying stocks right here hand over fist, but certainly if you've got a 2, 3, 4 year kind of time horizon and you incrementally buy stocks, this is not a bad place. But I think you'll have an opportunity to buy them at a little bit lower level sometime in the coming months.
What does incrementally buying them mean? Does that mean buying a portion of a position and repeating that over time?
Yeah, if you think, most retail investors, they incrementally buy stocks. So they're dollar cost averagers. They're in buying every month or on some sort of a particular schedule. And when we have pullbacks, and we don't think we're going to see a recession, but when our forward outlook is good and we get some pullbacks, we encourage clients, step it up, do a bigger amount, because really our clients, and I think you can safely say most retail clients in the U.S. that are out there, they probably have more cash in their account than they'd really like. They have money in there that they'd like to commit to stocks, but they've been pretty cautious. So what we're telling our clients is you have these pullbacks, you might be nervous. The financial media might be nervous, but that's the time to buy stocks. It's easy to buy them when they're setting record highs, but it's tough to buy them when they're down, and that's usually the best time to step in and buy.
Okay, we've got a board that we can put up on the screen that summarizes the preferences of you and your colleagues in this market. You favor U.S. large and mid-cap stocks over small cap stocks. You also favor U.S. energy, technology, and financials. Those are the first two lines on this board. Subsequent to that, we see your targets for the S&P 500 this year and your estimates on earnings per share in the S&P 500 for this year and next year. Let's focus on the first two lines. It's interesting that you favor large and mid caps over small caps, because when 2024 came to an end, there had been so much talk about a rotation out of large caps into smaller cap stocks and the Russell 2000.
Really, we've had a couple of bouts of small cap buying relative to U.S. really over the last couple of years, but we've been very cautious on small caps. We're neutral right now. We had carried an underweight position really probably for a couple of years, part of which was last year. But I think right now, with the uncertainty that's out there, companies that can show consistent growth, have strong balance sheets, good cash flow, they're buying back shares, they have easy access to credit. Those are the kind of companies that we like, and that would, of course, be S&P 500 kinds of companies. But also there's a lot of mid caps that meet that criteria. The smaller cap, if you look at just the Russell 2000, you have a very high percentage of those that are not earners. And then within that, they have a tougher time obtaining credit. They're more sensitive to interest rates. They're more sensitive to uncertainty. So, there's probably going to be a time when we would get more interested in small caps. Normally, it's when you're coming out of a recession or a meaningful slowdown, which we don't think we're going to have. There'll be a time for small caps, but really for the foreseeable future, meaning the next 6 months, 9 months, I think that's very unlikely.
Okay, and in terms of industrial sectors, you like energy, technology, and financials. Why don't we begin with the energy stocks?
Yeah, the energy it's been a tricky one, that's for sure, and we're a little bit relieved. It's a small percentage of the market cap of the S&P 500. But for us, we're going to see, another quarter or two of slower economic growth, slower GDP. But then as we go through the end of this year and in 2026, we're expecting some better growth, not just here in the U.S. We expect 1% GDP this year. 1.8 is our number for 2026. We're also expecting some better global performance. And that means higher demand for oil, higher demand for energy. And so we think there'll be some better performance for the energy sector as we move through the end of this year and in 2026.
What about the financials? They've done well recently, and they've been very much in focus during the Trump administration because, in addition to tax cuts, the market expects some move on reduced regulations that would make mergers and acquisitions more likely.
Yeah, I think that's a big part of it. We've got a combination of a couple of things, as you mentioned, more M&A, a lot less regulation. And I think that's going to be a big driver. But you also have to have a decent economy. And once again, looking ahead, after a few quarters of slowdown here, a better economy, more demand for loans, more deals getting done at the end of this year and then in 2026 as well. So what we've tried to do with financials is try to position, not time it perfectly on, when to get in, but just make sure that we have some exposure there. We're overweight now. We anticipate better times ahead. And it might take a little bit of time to play out, but we think financials still have some more upside.
In terms of geographies, am I hearing you say that you prefer U.S. stocks? I'm seeing that you are cautioning investors not to overweight their positioning in EFI stocks, that's Europe, Asia, and the Far East, or emerging markets.
Yeah, I think right now, those indices, several of them have done really well, and those stock markets have really performed well. We think they're way ahead of themselves. Europe, the EFA index, a lot of this, more defense spending because, the U.S. is backing away from so much security in Europe, and the Europeans are going to need to do a lot of defense spending. That's not something you flip on the light switch. That's something that's probably going to play out over the next 10 years. So I think there's a little bit too much anticipation built into the EFA index. And I would say, some of this bounce in the emerging markets is ahead of itself as well. Saying that, as I mentioned, the rest of the world's probably going to do better late this year and in 2026, but I think the U.S. is going to lead. And so for us, we definitely want to be leaning toward U.S. assets right now.
Scott, thanks for a great conversation. Have a good day. Scott Wren, Senior Global Market Strategist at the Wells Fargo Investment Institute. Up next, we'll head to Banff, Alberta for the latest on day 2 of the G7 finance ministers and central bankers meeting. We'll have analysis from John Curtin. He's director of the G7 research group at the University of Toronto.